Hello, everyone. Thank you for joining us for this new webinar organized by the Columbia Business School Alumni Club here in Chile and the Columbia Global Center of Santiago. My name is George de Bourguignon. I'm the president of the Alumni Club of CBS here in Chile. And for today, we have with us Rodolfo Spielmann, head of CPP Investments for Latin America, and Alberto Garrido, a CBS alumni fellow, who also works in CPPI, who will be leading the conversation with Rodolfo. And in this opportunity, we will be talking about perspectives on Latin America and Chile from Canada's leading pension fund manager, which is CPPI. So thank you, Rodolfo and Alberto, for being available to having this conversation with us today. I want to welcome everyone who has already joined to participate in this webinar, especially those joining us from the alumni clubs from CBS Brazil and CBS Peru, as well as those joining us from the London Business School Alumni Club, who have also been invited in this opportunity. We are constantly doing this type of event, so we are very happy to have this level of engagement and the possibility to have someone as Rodolfo here to talk with us. It's really a privilege. So I'm gonna leave now the space for Alberto to make an introduction, and thank you once again, everyone, for being here. Alberto.
Okay, thank you, George. Thank you for having Rodolfo and me in this talk with the Columbia University Network in Chile. It is a pleasure for me as an alum to be in this video conference. And I'm also following the club activities. I'm very happy for the work that the board has been doing, strengthening the network, the networking events, positioning the brand, and keeping strong relationship with the university. So before I move on with Rodolfo, I'll start by providing some background about CPP Investments, formerly known as CPPIB. It was recently rebranded. The fund was created in 1997 and is the largest and most important pension fund in Canada, managing around $350 billion on behalf of 20 million contributors. Most of the investments are made directly across asset classes from offices in all the continents with pretty good returns, 10% annually since inception. And specifically in LATAM, the fund started to invest 15 years ago. And interestingly, the first country that the fund selected to invest in Latin America was Chile, with an equity stake in the transmission company, and Costanera, which is the toll road that most of you have used in the past. Afterwards, the fund started to expand to other countries such as Brazil, Mexico, and Peru, developing strong partnerships with the most important business groups in those countries. For example, Carso Group from Carlos Slim in Mexico, Votorantim Group in Brazil, and today the assets under management only for Latin America are roughly $15 billion. And CPP has 33 people working in the São Paulo office. That's on top of the industry experts that are involved from Toronto, London, and New York. So the fund global target is to make emerging markets 30% of its portfolio by 2025, with most of the exposure coming from China, India, and Latam. So the challenge is tremendous for Rodolfo. And now moving to Rodolfo. Well, Argentinian, Guatemalan, moved to Europe very long, then came back to Latam, opened up the Bain office in Brazil, and then also started the CPP office in São Paulo. So Rodolfo, welcome to the webinar.
Yeah, thank you. Buenas noches a todos, and thank you, Alberto and George, for the invitation to join you at the Columbia Business School event. So it's a pleasure to talk to you and share my views, our views on LATAM and on Chile. So yeah, I spent previously to CPP Investments. I spent most of my career at Bain, actually. I joined after business school in 93 in Germany, then spent 7 years there, and the last 14 with Bain in Brazil. Helping to build the business there when there was only one office in the region. Now Bain has several offices, including in Santiago. So in 2014, when CPP Investments, as part of the globalization, internationalization strategy, decided to open an office in Latin America. Unfortunately, it was São Paulo, and I was based in São Paulo at the time. And while at Bain, I did a lot of work for financial investors. So Bain has a private equity practice, and while I was doing financial services there, at that time it was seen as a financial services subsector, like financial investors. So I did for sovereign wealth funds, for private equity funds. I did due diligences in several sectors. So I became familiar a little bit with the investment world, and then finally decided to change. And so I joined CPP Investments in 2014 when we opened the office in Sao Paulo. And at that time, we had roughly in Canadian dollars, with roughly 4 billion invested in Latin America. And most of that was actually in Chile. So the biggest investment, share of investment was in Chile and the whole of LATAM. Now we have roughly 20 billion Canadian dollars spread all over the region. Brazil, given the sheer size, has overtaken Chile now, but Chile is the second destination still. So, as Alberto said, we have now 33 people in the office. We are all, trilingual at least, besides of course, English, Portuguese, and Spanish. And we have investments besides Chile and Brazil, also in Peru and Mexico. What are our investment strategies? Our investment strategies one is infra. It's the biggest one actually in the region, where we have in Chile, and we'll go with that in more detail, but we have toll roads with Costanera and electricity transmission with Transelec. We have infra also with toll roads in Mexico with a partnership with the Ideal Group. We have renewable energy in Brazil, and then we have real estate, relatively important in Brazil as well. And we have a group that does public and private equity. So both, private equity investments as well as also investments in public markets. And finally, we have a relatively important credit investment group as well that is based out of New York, but is focused on LATAM, of which Alberto is part of. And this is roughly our groups that are most active in the region. We have others that do, mostly arbitrage and short-term capital markets investing that are based out of Toronto. But most of what we do really out of the Sao Paulo office is direct investing. So 90% of what we have done in Latin America is direct investing. So while traditionally you would associate, an asset manager that manages pension fund money with LP investing in fund managers, most of what we do is really direct investing. And to that point still, I think it's important to understand, while we have pension fund as part of our name, we're not a pension fund. We are the asset manager that manages exclusively the money of a pension fund. So basically you have the kind of pension plan that manages the compulsory money that both companies and workers save every month. This gets collected and we are transferred that money. So Canada is still in a relatively comfortable position based on demographics, but also because they've done a very, very serious job of protecting the pension savings, of actually being a pension fund that is in a surplus. So they collect more money than they pay in benefits to the retirees. And that money, that excess money, we have been collecting for 22 years now. And we have invested that money. And with an average return of 10% nominal in dollars, we can capitalize. We capitalize the dividends, the excess, the liquidity events, as well as the interest payments, and we reinvest that. So that makes us grow the fund at a relatively healthy rate. And also given that, we don't have to pay back money to the fund because the fund is still in a surplus, we have a relatively stable horizon and are able to invest long term. So that's a luxury. We have not that much to deserve this, but we have to work every day to make the best out of it. So, as you know, sometimes investors, they have liquidity events that are quarterly, that are daily in some cases, as hedge funds or private equity funds in several years. We have the luxury of being really within our maturities of assets, being able to invest short, medium, but also long term. And that leads us to be able to invest in asset classes like infrastructure. So I think this is a big overview, yes.
Yes, so maybe going into more detail around how CPP investments work and the relationship with the pension system in Canada, right? Which are two separate bodies. How can you explain the audience how do you keep the relationship with the contributors, the board of directors, the governments, the politicians? What is the type of interaction that you have?
Yeah, that's quite important because if in most countries in the world, really not just in Latin America, if you think of a state compulsory pension fund system, you think of political influence, you think of state intervention, etc. So the only place where we have a state influence is in the board of directors. So the finance minister has a say in the election of the board of directors, but the board of directors in our fund is all individuals from the market, so purely meritocratic. There's no politician or no former politician or no political appointee. And this board of directors, they elect the CEO. The CEO has always been a market executives, financial markets, etc. And the rest of us, are all people that come from industry, from the finance sector, from consulting, from different backgrounds. But there's no political appointee. So that's one thing. This is management and board. The other thing that is important is decisions by investment decisions that sometimes could be politically influenced or politically driven. In our case, there's no such case. We are totally independent investment committees. I'm part of the Latin American Investment Committee for all of the investments we do in the region. And I can assure you there's nothing whatsoever of any sort of directioning of saying, yes, you should invest in this mine, or you should invest in this toll road or in this railroad because it creates jobs, or it will get me elected next time, or so forth. And even more so, we have to report in Canada at least, any contact with any politician of any of our employees. So that's a rule. So it's relatively strict, and this was done, in our statutes in the 90s. It's relatively strict separation of what government is from what our asset manager is, and this is in the statute. So our only objective is risk-adjusted return. There's nothing like regional development, jobs, job creation, growth, whatever. And this is all the more, and I'll finish with that one then, this is all the more proven by 85% of our investments are already outside Canada. 85. Only 15% of our assets are invested in Canada. So we are totally free of investing wherever we want. We have no restrictions whatsoever. The only objective is really risk-adjusted return.
Interesting. So there's a question from Karen. How do you approach the selection of the board members? And if there's any policy in terms of gender parity?
Yes. Well, we have our chairperson is a woman, and we have majority of women in our board. So that has been in terms of diversity, that has been a relatively early policy where the board has focused. And the board has its own goals, and when we have to replace a board member, it's the board that that looks for one, suggests one, and proposes one. In the end, there is also discussion with the finance minister, and this embedded question on diversity. This actually we try to take that to all levels. So we started with the board, we're bringing it down to the different management levels. and we bring it down to everywhere. Our, out of our 3 business group leaders in São Paulo, we have 2 women and one man. So my colleagues basically. So we take that diversity point relatively seriously, and we have started so far successfully with the board, and we're trying to trickle it down onto the whole organization.
Right, interesting, and I guess that also applies to the portfolio companies, right? To the board members that represent CPP interests in the companies where we invest.
Yeah, that's one thing, and we also, more than that, we have, as you know, with our own investments in listed companies as well, we have a proxy voting. And we have started the proxy voting in Canada, voting against the nomination committee if they didn't have, starting with 10 or 20% of proposals for women in boards. And that has changed, over a 2-year time period, has changed dramatically how boards are composed already in Canada. So that's something we actively seek to do. It's not just our board representations; it's actually the full board that's of the companies we invest in.
Yeah, and then in terms of ESG and ESG policies, again regarding the companies where you invest, what are the approach that the firm has been taking? I know that we've been even more active lately with this. So can you comment on what's going on around ESG policies?
Yeah, well, some of this governance, we think, diversity is one, inclusion and diversity are important. So that takes a little bit care of the G part. On E mainly, we have been doing several initiatives. The first one we have, as you know, we have a big group that does renewable energy investments. That's bigger than 6 billion Canadian dollars so far already. So we are actively investing in the energy transition. We have not defined goals to exit without a focus on returns. So, but we want to invest considering the risk, that the environment brings, and also, with an eye on protecting the environment. But still, the last and most, ultimate goal is really risk-adjusted return. But as part of this energy transition, we're really very focused on investing in also renewable energy and to participate in the energy transition, towards renewable energy. And actually, we have a relatively big investment also in Brazil in renewable energy, which is a partnership with the Votorantim Energia Group, where we have invested in wind parks as well as in hydropower plants. So in clean energy generation. Yeah,
good. And then I see many questions in the chat, but I also wanted to ask you about venture capital and startups. There's been, I would say, a doubling down into venture capital lately. We recently opened the San Francisco office, and in the news with this IPO, where we are one of the previous round investors. That's also a very high profile investment in a tech company. So maybe we can use venture capital, startups, and the opening of the San Francisco office as an example. But I think most importantly is what's or how CPP approaches the execution and opening up to new asset classes, to innovate, which is not, well, obviously it's not always easy to start new line of businesses.
Yeah, so we have been debating with venture capital for a long time, and as an asset class, it's not easily scalable. Given we have now decided to invest $1 billion into VCs, and that's probably 10 to 15 investments depending on the size of the investments. So, and typically that would be too small for us for single investments. But we're not doing that just for the VC returns. We're also doing it because we think we will see high growth companies earlier and be able to accompany them earlier, not when they get to a 10 or 15 or $20 billion company. So, and then get into even A, B, C series and be able to accompany from an early perspective if you want the Ubers or so when they are in an earlier stage. Secondly, we also think it's a good opportunity to get closer to see emerging technology trends. And these technology trends are important because they impact a lot our existing portfolio companies. You know, we have between direct investments and fund investments, 80 or so billion Canadian dollars invested in private equity. So seeing how those technology trends will affect these companies, you know, or give opportunities to those companies is something that we want to understand better. So basically understand those technology trends, you know, see how artificial intelligence will affect that, how mobile payments will affect those. So see how these technology trends will affect those companies will be quite important for us. So it's not just for the sake of the VC returns, it actually has much bigger implications for us, and it's quite attractive. And by the way, you know, we have not been close to technology just through VC. As you know, we have been early investors in Alibaba, you know, 7 or 8 years ago already. When it was still a private company, we have been investors in Tencent, we have been investors in Ant Financial and so forth out of our China practice. So we have been close to technology also in other parts of the world. And now we think, you know, we need to complete that with a bigger focus on VC and being much early investors in this pipeline.
Right. And can you comment a little bit on the co-investment model, which is pretty unique to CPP? The fund was a pioneer in this scheme, and I guess this also gives us a lot of leads for new deals, right?
Yeah, and this is, you know, as an LP doing just fund investments, it's basically, you know, you make an investment and you wait, you know, and you do your quarterly calls or half-yearly calls to get an update on the portfolio, but you just have to wait for 5-7 years for the fund to divest and get your money back. But it's also not necessarily scalable because you have invested whatever $500 million and then you just wait. So the fact of having co-investments is showing our GPs to say, listen, if you have good opportunities, you need a bigger check. We can be there to give an additional 500 million or whatever the amount is in order to make a bigger deal happen. That would not fit in your fund, but if you ask some of your LPs to make co-investments, you can get to a bigger deal. Right. That also leverages our relationship, because if we think that this GP is an excellent manager, an excellent portfolio manager, that they can actually then, you know, manage for us more money and get better returns. And sometimes these co-investments have very good returns as well, because we have discretion to decide whether we join them or not. So that's been, especially in North America and Europe, quite a you know, common model.
Exactly. And what about in Latam? Has this co-investment model has worked out?
Yeah, it has. We have a couple of examples. You know, one of our, as I said, you know, very little of our investments are through funds, but we have Patria and Advent are, for instance, are some of our GPs in the region, Patria in Brazil and Advent as well. And we have done a co-investment, for instance, recently with Patria on SmartFit. SmartFit is a gym, health club, retail chain in the whole of Latin America. So last year we invested with them, you know, alongside. We have now 12% share in SmartFit, and that came out of, you know, a co-investment that we were offered because we also were an LP into Patria funds.
That's very interesting. And now moving to Latin America, we discussed early in the conversation that the fund selected Chile as the first country where to get involved, and then the fund started to diversify across the region. So, can you tell us, like, today, how do you approach the country selection, industry selection, and then maybe this is going to be a good segue to talk about Chile in particular?
Yeah. So, yeah, you know, before we even had a strategy of international business or so, we invested in Chile. That was in 2006 when we invested in Transelect jointly with 3 other Canadian investors. So that gave us comfort. And certainly Chile at that point gave us comfort because, you know, it was an early investment, great country. In the 90s already, it had started to attract capital, long-term capital, and, you know, very stable regulatory environments, you know, rule of law. and attractive comparatively. The Latin America strategy, and even we didn't even have an office in London or Hong Kong at that time. So that was probably quite adventurous in a relatively early phase of our fund. But the investment went very well. We're still invested after 14 years, 15 years almost, and it's been quite a good investment for us. And after that, we expanded. We developed international strategy, opened 2008 offices in Hong Kong and London, 2014 then in Brazil, a little bit later also in India, then Australia, and so forth. So and then even later in New York and now San Francisco. So and for LATAM we have 5 focus countries. That besides Brazil and Chile, it's Mexico, Peru, and Colombia. Those would be the only countries that we proactively build relationships, look for partners, and would invest. We have so far not invested in Colombia, not because we didn't try, it just didn't work out, but we have a relatively sizable investment in TGP, Transportadora Gas de Perú in Peru. We have the partnership with the Ideal Group in infrastructure, as I mentioned, in Mexico. And then we have the investments I mentioned in Brazil. So and then in 2012, we invested in Grupo Costanera, where we have 49%. And we also have a fund partner, Moneda, where we have invested into their credit funds. So this is basically our picture in Chile, where we have these 3 investments, and clearly, Grupo Costanera and Transelec are the bigger ones. They're among the biggest investments we have in the region overall.
Right. So CPP also has senior advisors in the key countries. What's their role? How do you leverage on them to make to have eyes on the ground?
Yeah, we have we have investments in these 4 countries, but we have only office in 1. And while we travel a lot, we see that we also need support. Number 1, in board positions. So we have almost all our board positions in Brazil. We have our own portfolio managers, senior portfolio managers, and so taking that positions. But when we go in the regions, we want to have a mix between our own people and senior executives from the sectors and from the country. That understand the whole environment, the business environment, regulatory environments, have the history, know reputations in the market and so forth. And they don't just help us with board positions, they also advise us and have relationships, and guide us and hopefully also tell us, when there are, things that we don't see that we should be seeing in terms of risk management, in terms of opportunities. So we have that in Chile, we have that in Mexico, that are, besides we don't have it in Brazil because we are all local. But we have that in those countries, and they're quite important. And actually in Peru as well, we have in those 3 countries, we have those senior advisors that typically also represent us in boards.
Right. And I guess, with all the noise, particularly in Chile, around what's going on in regulation, toll roads, utilities, I guess they've been playing an important role. But on top of that, what's your view on the recent change in the tone and the visibility in regards the regulation around the investments that CPP has in Chile?
Yeah, I think, as I said, Chile has always been, the if you want, a poster child in LATAM, given, the history, trajectory, reliability, and it was a no surprise environment, which is good. If you invest in illiquid assets in regulated sectors, the last thing you want is surprises or changes in the regulatory environments, etc. Right. And most of LATAM countries, know they have to behave well, because otherwise, capital just goes somewhere else. And and we are good examples. We have a global strategy. We have global emerging markets. China is huge, India is huge. Even if you take Brazil, Brazil have to offer something more than just size compared to those countries, because otherwise, no, if it's just for scale, we just go there. So we have to offer more stability, we have to offer more flexibility, we have to be friendlier to international capital and so forth. And you know, if you're small, you have to be even more so. So because otherwise, you know, you have to compensate the lack of scale for with something. And we have seen, you know, the worst places actually where you have the worst regulatory environments is either if you go to extreme cases like Venezuela in our region, but our worst experience have been actually in Europe, in Nordic countries, where, you know, after entering a long-term concession, just the government just changed the rules, and you end up suing. So some countries that don't need that much of capital, they sometimes behave unpredictably. But typically in Latin America, we even see it in Mexico now. We see it still in Brazil. We see it in Peru, had a little bit of a stress recently, Colombia, but we see somewhat of an understanding that if you don't behave well and if you don't treat international capital well, you know, you don't have the depth of long-term capital in the country and the funds and the savings to actually, you know, develop big long-term projects. And I think, you know, starting in the 90s, Chile did it very well, you know, after coming back to democracy, of actually attracting long-term capital with very stable conditions, attractive conditions, and making the country grow very, very strongly in the 90s and even in the 2000s. A little bit of that is getting lost now, and we see that, you know, some of this predictability is less secure. You know, we've seen change, and that's part of the regulatory environment, change in the electricity sector, in transmission, and that not just over the next 6 months. We've seen that over the last couple of years, but that was part of the regulatory environment. So there were not surprises, but it was just tightening returns as part of the negotiations. And I think toll roads has also been a challenging place. What we've seen, you know, putting public pressure on operators to reduce tariff increases. So, and this is public, you know, we've entered in one of our assets into an agreement last year to reduce our real increases to zero, even though the concession was allowing for 3.5 real increase, with in exchange for an extension of the concession. But, you know, it's a different risk profile if you do that, because you something that is written in the concession contract of an increase, you exchange it for something that will be done at the end of the contract, which is always a different risk profile. And then now we have discussions on dynamic pricing, and, you know, we have an arbitration coming. So you know, what probably would have been in the past something that would have not been discussed, now it's being discussed, and you know, that's something that definitely it changes the risk profile and adds some volatility, some regulatory volatility to the equation. That was not the case before, and that's part of life. So that's something we have to deal with. But that's also something that in a way is gets transferred into a risk assessment of each investment.
Right. So I infer from that opinion that, well, obviously the view on Chile has changed, has shifted a little bit since the latest developments. Did you stop, let's say, looking at opportunities in Chile, like reassessing like the weight of the country within your portfolio? Like, obviously it creates some noise, but how do you reassess your approach to the country?
Yeah, this is an ongoing process. So this is not something that started and ended. And I think this is just starting, because you know, we'll see over the next 2 years probably how this develops. We'll see, you know, what the outcome of the election is for the constitutional reform. We'll see how this constitutional reform will end up. And I think this will probably be a 2 to 3 year process to see where we come out of that. But we are open to understanding. And I think It's part of the, if you want, of the democratic system, that if there is trends going into a different direction and society wants a change, that's something we are just takers of that. We just need to understand how this develops over time. But we think it will change. I don't think it might even not change much, but the perspective now from what we hear from our political advisors and so forth is that there is some change coming, and we don't know. We just need to see how this, and I don't know if anyone knows, of course. We just have to see how this develops. But this whole uncertainty is definitely a factor that we have to consider. So we haven't changed our investment plans, if that's your question. We have in Costanera, we have roughly $1 billion of new investments committed. But we could easily say, instead of doing this in 2 years, we'll do it in 4 years. So that's or in 5 years. So that's something that there's still some flexibility there. We're not intending to change that, but I think that's a factor. And if you think of new concessions, if you think of new investments, what is the return rate that investors will demand? Will it be the same that they demanded 2 years ago, 1.5 years ago? Probably not.
Right. And when you compare, have you seen similar situations going on in other countries within LATAM, maybe triggered by social unrest, as it was the case in Chile? Are there any other precedents that can help the Chileans to see how things may evolve going forward?
Yeah, no, I don't think so. And that's something. It's always tempting, if you look from New York, London, or Toronto, to say, well, it's LATAM. No, it's not LATAM. Every country is a different world. If you look at Mexico, a lot of people were scared in Mexico, and if you were invested in energy, you better be scared, because things have changed a lot. For us in toll roads, it's been fantastic. And we have been, last year I spent a lot of time in Mexico, and we have been evaluating that a lot before doubling down. If you are in Peru, I think Peru, depending on the sector, it was a little bit scary. It's become better, as there has been the reduction in the tariffs, or almost the abolition of the tariffs in the toll roads has been cancelled now, so they will continue to keep charging. But there were also discussions on take-or-pay contracts for gas transmission, in which we are in, that were also a bit scary, that now are out of the way. So I think this pandemic has given us some shocks, some surprises, but it's stabilizing more, and I think every country has had a different dynamic. I think sometimes in this dynamic, it helps to have a government that it is a little bit more center or more popular, to deal with those pressures, with those social pressures. And I think that's something, certainly what's the case in Mexico. I think Mexico so far has dealt well with the pressure, even though the pandemic is not at its peak yet. So I think every country will have different outcomes, and I think it's hard to generalize for LATAM to say, this is the model and this is what will happen. And right. I think Chile is no exception. I think Chile will be a case. It has its own dynamics, its own history, its own momentum, and I think, but it's probably where the changes will be the biggest. Given the constitutional, the new constitution, given the referendum, and then elections and so forth. So it's probably, I would expect the changes to be or potentially be relevant. Yeah.
Right. At least, would you say that you have a counterpart where you can have technical conversations around the situation? Is there a fluent dialogue with the authorities or the people who manage this type of regulations?
Yeah, we have a constant dialogue, and even now, we typically would have traveled twice a year to meet most of the technical ministers, from the MOP to finance, central bank, etc. At this point, we do this virtually, and it works very well. We do meetings like this, and there is very good technology and discipline, and also education to do these types of interactions. And we have been very open in stating, you know, what we have observed in the past and what we're observing now, and what the challenges are, and that we remain vigilant on you know, of stability of regulatory environments. And I think, you know, if it's within the rule, even of a concession, if you go to an arbitration process, etc., it's all within the rule of the regulatory environment. But you know, it doesn't help if it gets discussed in public, or if there's public pressure, or if there's, you know, bad mouthing in the press. That's where we really see some bigger challenges, because that's you know, when populism starts to appear, that's where we get more worried. If it gets all discussed within, you know, the rule of law and the regulatory environments, then that's fine.
Makes sense. Makes sense. And now changing the topic, COVID. Of course, we're gonna talk about COVID. How are you keeping up with the pandemic, and how do you keep your team engaged, not burned, being working from home for the last few months, like as a manager, as a leader of an organization?
Yeah. You know, it's good that we have learned a bit. You know, this has been 5 months and a few days for us in working from home, and you know, probably the first 1 to 2 months were high adrenaline, and you know, we have to go through this, and we're in this together, and and now in months 3 and 4, it's where, you know, a little bit of this, you know, we never thought or planned or even dreamt that we would spend more than 1 or 2 months in this format. Now we are in 5 and counting. So we had to really we had to really think how to best engage and continue engaging, and even now we're making plans that could probably be end of September, October, to come partially back to the office. But we have been working hard to keep teams connected, teams engaged with different formats. It's all really video. There's not much more than that, but it's not all transactional. Some was to just get together to chat, to share, etc. So that's something that we've taken very seriously, because we were worried. Sometimes someone needed a break, and people got breaks or got vacations, even just to spend time with family and friends, not travel, of course. That was and it's still
like vacations at home.
Yeah, well, some people went to countryside, went to the beach, to houses they have there or rented. You know, Airbnb is in big demand here for that type of situation. So we have dealt with that. But it's been a challenge, and also, you know, we have been focused on the other side on our investments. We have been focused a lot on our portfolio companies. So the first act was to say we have to secure that our portfolio companies are well capitalized, and we have to understand if this pandemic really hits hard and this is the impact on the economy, how long will businesses be closed? We had shopping malls that were closed for months. You know, SmartFit was closed for months. Now, fortunately, most of SmartFit gyms are open in Brazil, not so much in the region. We have 100% of all shopping malls in Brazil already open, and ours as well. So at least we see some light. Of course, the traffic is not there, and the revenues are not there, but you know, the worst case scenarios are out, and we now have a better planning scenario. And also, you know, that is quite important in North America, you know, where people thought about even 30% you know, unemployment rates. For Canada, we're inclined to see 1/3 of the workforce unemployed. So the economy would have taken a big hit. This fortunately didn't happen. So we also see there that it's not as bad. We see a much better situation on our liquidity as well. You know, we have also portfolio turnover, so we have some asset sales and improved liquidity position. So we're now in a phase not just of supporting our portfolio companies, but also thinking, you know, what could our portfolio companies do to actually take advantage of the downturn and expand inorganically through M&A, or what other investments could we do taking advantage of the disruption in sectors that have not yet corrected, you know, so corrected back up. So we now, if you want, in phase 2 of this, you know, the phase 1 was really defend our own portfolio companies and, you know, secure them and until we understand where the economy is going and where our companies are going. Now that we have a better grasp of that, really focus and say, you know, where can we have expansions and can we, you know, can we help to grow through M&A with our portfolio companies, or even invest in new companies that could be winners coming out of this pandemic.
Right. In emerging markets is pretty different from obviously North America and what's going on in Europe. But despite the differences, are you taking some of the knowledge from what's going on in the portfolio companies in these other regions and kind of bring that know-how and like kind of visibility in terms of consumer behavior or different changes in the underlying business to kind of proactively manage your portfolio?
Yeah, and the answer to that is probably two-pronged. So the first one, what we're doing, we have just very standard, approaches to whatever is cash flow planning, scenario planning, etc. So that's very unified, in terms of asset management. The other thing, and we haven't yet ended up, we have global teams that are working the future of the office. There's been a lot of talk of future of the office, but that's not such an obvious response. So our portfolios in offices in São Paulo, we're just one tenant leaving 2 floors. That's about it. That's already being replaced. So depending on where you are in the office space, you could be in a bad place or in a good place. The future of retail, where is retail going? Shopping malls, high street, e-commerce and so forth. So we have really global working groups that are focused on developing our proprietary point of view on this. And they haven't done yet, they are not finished. This is just work in process, and they'll probably take a couple more weeks or months to come to a conclusion that could be, where these sectors are going for the next 3 to 5 years. Because that will really be a factor that will drive also our portfolio decisions. Similar, what will happen, toll roads, will people drive more themselves? Probably yes. Will it be good for toll roads? Probably it will. So autonomous vehicles and so forth. So there is a lot of these trends that we are reassessing based on habits and, as you say, on consumer behavior and so forth, to understand what is going to happen, where sectors and companies might go. But that's something that there are all global teams working on that, and we will have different views per region. Shopping malls is different in Brazil and in Chile from the US or Europe or even Asia. So we have to have also regional lenses there that are very strong.
Exactly. And did the pandemic change the asset allocation strategy or appetite to invest in the region or in emerging markets?
No. And our CEO has said that, publicly, privately, and to all audiences. We have our stated strategy of being up to 1/3 in our asset under management in emerging markets. By 2025, we are supposed to have something like 600 billion CAT. We know at 440. And this is not even very aggressive in terms of returns. And 1/3 of that is up to 200 billion. We're now roughly at 110 in emerging markets. So this means doubling in absolute terms in emerging markets. For us, this means doubling in LATAM, going roughly from 20 to 40. It's not a target because you can never have targets in terms of investing, but it's a portfolio approach to say you could go to up to 40 in LATAM. So, and if we don't, that's fine. We'll invest in passive ETFs and so forth, even in the region if we want the regional experience. But if we really do alpha in the region, we have to select our assets, and that will be, we can go as high as that. So no, the pandemic hasn't changed that. Geopolitical situations can change that. What happens with China, we don't know. China, US, China, Canada, that could be a factor. But if anything, LATAM, irrespective of domestic problems, of challenges in every country, I think as a region could only benefit from that. If we think of the integration of the USMCA between the US, Canada, and Mexico, that's a favorable trend. And we could think of others as well in LATAM that could be very favorable. So, but in some cases we just need to bring our houses in order to be, as attractive or more attractive than the options in other parts of the world.
Right. It is super curious that given like the geographic proximity between South America and North America, we haven't seen this like boom in industrialization and trade that, for instance, the U.S. has with China, like, and being more, closer. What do you think is that? Like, why do you think like factories that are today in China are not in Brazil or in Mexico?
Yeah, I think that is a little bit of history, cost, positions, and so forth. But I think this is now the chance with the geopolitics to actually become closer and see the US more as a big market for Latin America, to get better integration. Ideally, also with Europe, I think the opportunities to better integration with Europe, and not just become exporter of commodities, but actually also of semi or manufactured goods as well. So I think this is a great opportunity, and we have to be realistic. Globalization will take a little bit of a pause, if not even recede. So within that, the challenges will not be smaller, but I think the opportunity is still there. And Latin America doesn't have any big geopolitical situations or challenges. So I think there is an opportunity there to capitalize on good diplomatic and political relations also on the economic side.
Right. How do you go about developing these relationships with the countries, with the business groups? You recently wrote a report on family-owned businesses, which are the most, right, in South America. So, and for a North American firm, I think it is harder to digest the fact that the most relevant actors in each of the countries are family-owned businesses, which is something that you don't find in the US or in Canada, for instance. So that's a challenge that I find by myself. How do you go about that and kind of dealing with family-owned businesses? How do you select? How do you foster those relationships?
Yeah, that's a fantastic topic and one of my favorites. And we think of ourselves, as I mentioned before, given we have the luxury of owning an LP with long-term horizons, to be also long-term investors. And the way you align long-term interests is someone who's also interested in the long term, and that's really families who want to perpetuate growth. It's not necessarily true with corporations where you have really an agency problem where the focus might be much more on the quarterly return or even in the yearly result. So we find much better alignment as long-term investors with family-owned groups that think of long-term returns and long-term asset value. And if you think of it, if you go to Europe, if you think of car manufacturers in Germany, luxury groups in France, banks in, just take Santander in Spain, the apparel companies and luxury good companies in Italy, most of them are all family owned or family controlled, if not majority owned, but family controlled. If you go, some of the tech groups in China, you go to India, even if you go to the US, I would challenge you. Look at tech. Tell me which company in the tech sector, all the trillion-dollar companies, they are all, founder controlled in one way or the other, all of them, and they are still relatively young. And why?
Yeah.
Think long term. They're not perfect corporations where you have a manager, that wants to optimize his share options, his stock options in the next quarter, next year or two. So we think there's really a lot of DNA commonality between how we think long term and how family groups think long term. And we've had fantastic experience. Just take the Slim Group in Mexico. Just take the Votorantin Group in 6th generation already, the Cirela and real estate. And that combined with the factor that we never run a firm, we never operate our assets, we always look for an operating partner. That's where we combine long-term interest with a strong operator, and that's a perfect match because we know what we are. We are financial investors. We don't run firms. We're not experts in running firms operationally. That's where we need our partner there. And sometimes that might be just a company that has a long-term view, like we have in Chile. We had first had financial investors for Transolec, and then we had a toll road operator for Grupo Costanera.
Right.
but usually, yes, we think very highly. You know, it's not every family, of course. We think that, you know, they have
I
to.
guess you have your short list.
Yeah, we are very focused, and we think, you know, it's not just excellent operators and long-term view. It's also, you know, it's compliance, it's transparency, it's business practices, it's culture. So, and sometimes it takes years to develop those relationships over time with those families to align and see a common project. And we're not transactional there at all. You know, we don't go through intermediaries. We go directly, and we want to develop these relationships directly in order to see if there is alignment. And then, you know, just wait for opportunity to come. It can take 1 to 5 years. But then we think that when there is alignment, those opportunities are worth waiting for.
Great. Hopefully we can find some of those partnerships in Chile. Another topic that's been on the news lately in Chile is the pension fund reform. So I sometimes compare with what the media says about CPP Investments in Canada, and it's a different question. Like, people in Canada ask themselves if CPP is going to be there when they retire. In Chile, the conversation is more like, is it okay to have them? Or like, should we do it in another way? And then if we talk about the rest of Latam, they're just a mimic of the model with some tweaks that we have in Chile. So what's your view on that? Do you have discussions with your peers? What do you think about the role of the local pension funds within the system?
Yeah, I think, you know, we in Canada, CPP is just one pillar of retirement, and it's a small pillar. So people actually, you know, besides the state compulsory, sort of saving and retirement, there is also, you know, affinity groups. That's the teachers, that's the public servants, service employees, and there's the private that is managed by banks. That's much bigger still. So I think a combination of different types of retirements is one way. Certainly, you know, in terms of return, if you think and this is all transparent in public, our cost per year is 31 basis points of AUM, 31, for a return on average of, I think, of the last 10 years, even 10.5. So in dollars. So that's I would not even be humble here and say it's not a bad deal. I think that's a good deal. That's a good return on investments. So if you think of that over a 20, 30, 40-year period, if this continues this way, and our minimal, because we're defined benefit plan, our minimum return nominally is 6%. So and we have done 10.5 over the last 10 years, even taking this last year of financial crisis. So that's a pretty good return. But I wouldn't say, you know, you cannot have the whole system this way. But I think as an additional pillar is probably something that is quite helpful, especially for the ones who cannot save. And who are, you know, in the middle to lower income of the segments. But, you know, I cannot dare assessing. I don't know the Chile pension model so well as to give any diagnostics there. But I think for Canada it has worked well, and I can say for other countries like Brazil it would work fantastically well. You know, given it's done, given the chaos that the public pension system is in Brazil, which is not the case in Chile. Chile has a different model, and one that has been, you know, also a case for a long time. But yeah, I think it worked very well for Canada.
Okay, excellent. So we're just in time. We have 1 minute left. So I just wanted to thank you for making time in your busy agenda to be here with us, and thank you again, the Columbia Center, for inviting us.
Yeah, it was a pleasure to speak to you all. Thank you for joining me joining us at this time. And yeah, look forward to continue investing in Chile, and hopefully we'll find some more opportunities. Well, great talking to you.
That would be fantastic. Thank you, Rodolfo. Thank you, Alberto, for a very interesting conversation. We really appreciate your time, and thank you everyone else for having joined as well for this webinar. and hopefully you can continue participating in future events that we organize. So thank you everyone, and have a wonderful afternoon. Bye.